Okay, well, it's coming up to the end of December here. I'm going to give an outlook for 2022 and a couple of interesting trades that I'm going to be putting on. I shouldn't say that I'm going to. I already have started putting them on. But before I get to that, while I have a captive audience to some degree, during the last 2 weeks of November, first week of December, we had a hat sale where we were raising money for Big Brothers Big Sisters, and we didn't hit our target. We wanted to raise $25,000. That means we had to sell 333 hats. We sold about 200 and some odd, 220, somewhere around there. So for those of you who did buy a hat, you would have gotten this message in your in-mail system, which is on our site. And the important part is in the green here. For the month of December, for each candidate that uploads a picture of themselves wearing the hat, we're going to donate another $25 to Big Brothers Big Sisters. So this gives us a chance to hit our target. Doesn't cost you anything. Take a picture of yourself with the hat. If you scroll down in this email, you'll find the link where you can then upload your picture of you wearing your hat. And there's a couple of suggestions of maybe you're wearing the hat in the office, maybe you're posing in the hat, maybe your dog is wearing the hat. Maybe your snowman is wearing the hat. It doesn't have to be you. It could be any of those things. Get creative. And if you upload that picture, we'll add another $25 onto our donation. Okay, let's jump right in to what we're doing here. And I'm going to go through a number of screens first because we got to go through some data. You sort of have to set up the environment that you think we're going, or well, not that you think, but that I think we'll see in 2022. And everything that I'm using is directly from the curriculum that if you have level 1 behind you, you should understand all of the economic data that I'm about to go through. And if you've got level 2 and 3 behind you, you should understand the option strategies that I'm going to use and the ETFs that I'm going to use. I'll also be showing a currency trade and a short strangle on a stock that I particularly like. So let's begin. And I'll walk through what's going on with inflation, and then we're going to look at corporate profits as a share of GDP and contrast that with wages and salaries as a percentage of GDP. Then we're going to look at the participation rate, and we're going to notice some oddities, some very curious things that simply can't continue on, that there are trends that have been in place for the last almost 20 years that are really unsustainable and I think coming to an end. And so I think 2022 is going to be a tough market. I think a volatile market, a generally sideways market with some slight drift upwards, but we'll get to that. I want to lay out my argument. And while I'm going through it, I'll point out some oddities as well, things that for me, I can't seem to solve the puzzle. So if I can't solve the puzzle and I can't seem to think through it, I sort of think, well, then that puzzle can't continue. That trade, obviously there's a trade involved. Let's start with inflation. Inflation has been the talk of the town the last couple of months, and I think a couple of data points are going to be really, really important into 2022, and I think inflation is going to be, the popular kid in class for at least the first half of 2022 is keeping an eye on inflation. And inflation right now is the argument that I'm going to lay out is it's not something the central bank can solve, but it's something the central bank has to be seen as doing something about. And I'll explain on the next screen why I don't think it can be solved by central bank activity. So let's just look at where we are here. Headline inflation in the U.S. that was reported last week, 6.8% annualized, highest since early 80s. That's a big number. If we look at core strips out food and energy. And the reason it does that is because food and energy can have its own inflation, even if there's no inflation in the general economy. So sometimes it can skew the numbers. And sometimes it just works with the general inflation level that it goes up as well, but it can behave on its own. So if we strip that out, we get an idea of the underlying economy, goods and services. What's the general price level there? 4.9% increase in the general price level. And there is something called core, which takes out housing and used cars and trucks. only because not everybody's in the market for that. If you think of all the homeowners that existed before inflation really showed up, they're not subject to any inflationary pressure on their housing. And if you're not in the market for a used vehicle, you're not subject to that as well. So that's taken out. You get to 4.1%. However, while the Fed will pay attention to the 4.1%, all individuals have to buy food and energy, but may not be subject to this term here. So the difference between core and core is 0.8. So if we take 0.8 off the 6.8, we get to 6%. You can say that that is the level of inflation felt by the average household buying the average basket of goods. Wage inflation over that period has been 4.8%. So you may say, well, 4.8 versus 6%. The 6% is probably overstated because it doesn't shop around. It doesn't buy 2-for-1 items. It doesn't try to negotiate better deals. It doesn't downgrade on the brands. It doesn't do any of that kind of thing. So, most people probably aren't realizing 6%. The average household is not realizing 6% if they can shop around. They might be down to 4.8%. So maybe this is not such a bad thing. But this is an increase. If we think 6% is an increase in prices and you get a 6% raise, you're doing okay. But your raise is taxed. So you don't actually go home with 6% after tax. So just to keep purchasing power constant, that is no raise year over year for more experience. Just to keep purchasing power constant, if we assume a 33% tax rate, that requires a 9% wage increase just to be neutral. And wages are 4.8%. So I think there's significant wage pressure going forward, especially if inflation doesn't start coming off the boil by the second half of 2022. I think there's going to be significant wage pressure. I also think there'll be significant wage pressure because of something I'm going to show you a little later, a few screens later, on the participation rate and the trend on the participation rate. So there we go. There's inflation. Let's look at yields, and this is as of December 10th. This is as of the close on Friday. Nominal yields and real yields, and this is all the charts that I'm using and all the data that I'm using is freely available from valid sources. This is from the Treasury. If you look in the description box, all the links are there. I'm using either St. Louis Fed data or Treasury data. So they're from valid sources. Look at the yields. Again, 6.8%. Even if we look at core, do you see a 4.1 in here anywhere? And if we think it's just transitory, okay, well, look at the 1-year yield. That's a nominal yield, 0.27%. The bond market is just saying, so what? And we think that nominal, we were taught that nominal rates is equal to a real rate times the inflation premium, or the real rate plus an inflation premium to get to a nominal rate. Well, it's certainly not in there unless you have significantly negative real yields, which we do. There's the 5, the 7, 10, 20, and 30. So if I take the 5-year at 125 nominal and you got a real yield of negative 151, the inflation expectation in there is 2.76, which drops to 264 on the 7-year, 244. The 10, the 20 are pretty much the same, dropping to 2.24 on the 30-year, which is very, very close to the 2% Fed target. So long-run inflation expectations are saying, you know what, we're just going to use the Fed target here. But even the 5-year and the 7-year, while it's elevated from the 2%, isn't really reflecting much more than, this will be over in a couple of quarters and everything will just be fine. That it's not treating it as anything more than, an extended transitory period. And even the Fed is saying, at their the last press conference, the last statement from Jerome Powell, I think it was it was the last statement when he was in front of Congress, saying it might be time to retire the word transitory. The bond market doesn't think so. But, this is inflation. And today is Monday, December 13th. The Fed is announcing on Wednesday, the 15th, in 2 days. Well, nobody is expecting rates to move. Nobody. But we are expecting a significant increase in the taper, in the amount that they're purchasing, and starting to walk towards purchasing nothing and stopping the increase in the balance sheet, and then moving towards rates sometime in the middle half of 2022 would be the first rate increase. I don't know that any analyst has the overnight rate over 1% by the end of next year. However, we're at 0.05, 0.03. Look at the 1 month, 0.03. So, even if you go up 75 basis points, that's going to raise yields on all the tenors, because you do have an upward sloping curve. You got a pretty flat curve all the way out to probably the 1 year, and then you start to have an increasing curve. So I think you could be looking at a bearish 2022 for bonds, and if it is not transitory, if it does extend longer, inflation expectations are going to have to start being built into these rates, at least higher than what is reflected here. So I think 2022, if we're looking at factor exposure, I think you'd certainly want negative duration in 2022. So we're going to look at an ETF that tracks the 20-year. It's called TLT, and we're going to see what we can do with a short position on TLT so that we can get negative duration. Okay, let's with inflation in mind, let's think about how inflation comes about. And you should recognize this formulation here. Nominal GDP growth is a function of real GDP growth plus inflation, or price increases. So you can have 6% GDP growth with 6% inflation without the economy making a single thing more than it did the year before. In fact, you can have an economy that is shrinking in real terms, let's say 2% lower real output, with 6% higher prices, and you'll still have nominal GDP growth. So to get real growth, we need to see that nominal GDP growth is higher than the growth rate of inflation. So the next print on GDP is going to be watched very closely as well. That's going to be an important point, because now that we have inflation data, whatever our read on GDP is will give us some indication of what real GDP is. And nominal GDP can be demand or supply driven. Demand driven meaning excess demand in excess of what supply is can drive up prices, and can also encourage suppliers to increase output as well. Or if the consumer pulls back, it would cause suppliers to cut back as well. So you can have demand increases and decreases will affect the amount of stuff being bought. And at certain points, if demand exceeds supply, it will begin to affect inflation. You can also have demand sitting still, and you can have supply dropping, which is what we currently have now, and that would create inflationary pressure, but negative pressure, or at least downward pressure on real GDP. So that's why the next GDP print is going to be important, is what is the real component of GDP now that we have an idea of where the price level is, or I shouldn't say the price level, but the level of inflation. We can back that out and get real GDP to determine, what the economy is growing at. So right now, the level of inflation that we have are primarily supply issues, and in two broad types. Number one is you have supply chain bottlenecks in a lot of places. There's ships that are arriving at ports that sometimes have to wait 3 weeks out at sea before they can come in and empty their cargo. You have shipping rates that are elevated, and the lease rate per day for these vessels add to the cost of the landed goods. So that's driving prices up. You also have a labor shortage for a couple of reasons. We had a labor shortage beginning before the pandemic began. And I'll show you in a few screens why I make that comment. And the pandemic actually worsened it, that the participation rate dropped significantly, and it's starting to increase, but it's well below where we need it to be to improve the supply issues. So any central bank action is only going to affect asset prices. It'll be negative for asset prices. Now, negative does not mean lower asset prices. For bonds, I do think it does mean lower asset prices. But for equities, it could just simply mean lower returns. If you look at returns over the last 2 years, it could simply mean just lower returns. And to determine whether or not we're going to have negative returns or lower returns, we have to sort of say, well, where do we stand right now on corporate profits as a percentage of GDP? I do expect the share of corporate profits as a percentage of GDP to drop, but are we low or are we high? And if we're low and I expect it to drop, then yeah, you could say, well, negative returns. But I think you'll be shocked when you see what the number actually is. In fact, I think I'll show you some very surprising trends. And this is why I said earlier that the trends I'll be showing you have been in place for quite some time. I don't think can continue. I think are unsustainable trends, and we're seeing that. I think the pandemic just really brought it to light. So I don't think we're going to have negative returns, but I do think that there'll be downward pressure on equity growth. Well, I think we'll still have positive growth, but certainly not what we've had the last 2 years. So let's talk about this funny looking chart I got. You know, you're looking at it saying, I've never seen supply and demand curves drawn that way. You have seen this kind of supply curve before. This is called a constrained supply curve. This is a short run aggregate supply curve. Typically short run we think is shaped more like this, and long run aggregate supply tends to be fixed. In the short run it tends to be fixed because you need capacity to build out. Well, there's two types of capacity. There's physical capacity and labor capacity. Build the biggest factory you want. If you have nobody to work in it, you have no output. Right now, there is no physical capacity constraint. There is a labor capacity constraint. So what happens when you have a constrained supply curve is it doesn't shift inwards. We think, well, if you have a constrained, or if you have lower supply, it shifts inwards. It doesn't do that when it's constrained. It begins to look like the long run aggregate supply curve, which is fixed. It tends to increase its slope. So we have a very steep constrained supply curve. And we have demand currently now that exceeds supply. However, whenever you have a situation like this, where you have consumers that do want to spend money, but the supply isn't there, they tend to be very price inelastic, saying that, well, it costs what it costs and that's it. It doesn't really destroy demand until you get to a much higher level. So way up here on the price index or the price level, you'd start to get demand destruction. You'd notice that it's curving in towards, like quantity is dropping very quickly with every increase in price. But here it's fairly inelastic. But we do have a situation where demand is greater than supply. If you look at the car companies, pretty consistently, all of them are saying, listen, we can sell every car we build. We don't have a demand problem. We have a supply problem. And their problem is the chips that go into the cars. I had a sliding patio door on order for months. A ridiculous price on it, by the way. I'm glad it got canceled, but this weekend I found out that it's not going to happen. You're not going to get it. So there was demand for a door at a very high price, a price I didn't want to pay, but you had no choice, really, if you want your door fixed. Well, I'm not going to get it. So, it's not a question of there was no demand for that door. There just is no supply of it. So even if I had 20 of them on order, it wouldn't matter. You're just not going to get it. So demand is greater than supply right now. So imagine a situation where you have 500 units of something on demand, but only 200 being able to be supplied. What would it matter if you were able to cut demand to 300? These suppliers wouldn't budge on their price at all because demand is still greater than supply. So even if a central bank acts to try to change the demand curve inwards, well, here you are. Demand still is greater than supply. And in fact, to get the market into equilibrium, the price would still have to rise. So you could have a situation where the central bank does something to affect demand, and the price and inflation just keeps going up. That the price level keeps rising. Maybe the rate of inflation doesn't increase. Maybe you'll have 6-7% inflation for 5, 6, 7 quarters. without it being fixed until you can actually destroy demand this way. You'd have to really destroy demand to begin to put downward pressure on the rate of inflation. You'd still have a rising price index, but downward pressure on the rate of inflation. Now contrast that with fixing the supply issue. And let's just get the right color here. And let's say that we could increase supply. Actually, if you could increase supply, it would start to flatten out like this. There you go. You can get into equilibrium here. So, you know, the central bank can do what it wants, but the central bank typically acts on demand. Any increase in raising rates tends to, at the margin, will constrict supply a little bit because of a lack of investment. But it tends to work on demand first. Well, when demand exceeds supply, you first have to destroy the glut, the demand glut first. And prices can still rise into that. So, you know, they have to be seen as doing something. I get that. So that's why I think the U.S. Central Bank will probably say, look, the asset purchases, what do we need the asset purchases now? I think it's safe to pull those back. I think there'll be some chatter about rates, increasing mid next year. And perhaps that would be welcome chatter from the central bank to say, well, you know, it'll keep nominal rates down. And if it keeps nominal rates down, good enough. But I think they're well aware that any interest rate hikes on their part without a definite increase in the labor force participation rate isn't going to have that much effect at all. The other thing that they have to be careful about is they don't want to destroy wage inflation. Now, if you look at inflation, you say, well, where is the majority of this inflation coming from? There are some estimates running anywhere from 40 to 45% of the inflation is a result of wage inflation on its own. Well, then that's actually a very good thing. There's nothing wrong with wage inflation if that's where the price level is coming from, is from wage inflation, as opposed to just accruing to corporate profits. But we'll see in a few screens what we make of that. Anyways, this is sort of a big thing here. I think you're going to see central bank action through 2022. I think it'll affect the demand curve, but unfortunately, it's not going to affect the price level. I think you'll continue to have wage inflation, which is why I'm a little not negative, but not bullish on equities, but I am bearish on bonds simply because you are going to have central bank action. Okay, these two charts here, super interesting, and the trend in them is troubling. The first one is corporate profits after tax as a share of GDP. The second one is compensation of employees. This is wage and salary accruals as a percentage of GDP. It's basically who's getting the income. And for a long time, 6%, if we sort of bracket this out here, 6% has been an attractor point for corporate profits as a percentage of GDP. In a time series sense, you would say that you have a covariant stationary time series during this period, with 6% being the attractor point, or being the mean reversion level. But since 2000, we were way down here. Look what's going on since 2000. Is you've gone all the way, this point over here is almost 12%, double the mean reversion level. It's the only thing that made it mean revert was the financial recession we had in 2009. And even the pandemic didn't get it much below 8%. This is 8% over here, and up it went. Look at employees as a percentage of GDP, and you had, a fairly stable series within here till about mid 70s. Well, you could even point to here, which is the beginning of just before 1970, and you have this long move downwards. This is 42% down here, and this was in the range of 49 to 51%. So you have about 8 to 9 percentage points less in GDP that is going to compensation for employees and wages. But over from 2000 onwards, you had just under 5% to over 12%. And even if you take this point downwards, you still have this downward trajectory going in here. This is interesting, and we'll line this up with the participation rate. And the participation rate has got an anomaly from about 2010 onwards. There's a real anomaly, and I think that this was the breaking point of the anomalies, that you can continue on with something that seems unsustainable for a number of years, but at some point it's going to break. And we did see it starting to break before the pandemic. Up here, notice up here what was going on before the pandemic is you had corporate profits as a percentage of GDP decreasing over that period of time, and you had wages starting to increase over that period of time. Well, that would make sense. If more of the share of GDP is going to employees, we would expect less of it to go to corporations. And that's because during this period of time in here is you had some of the lowest unemployment rates. So the unemployment rate in the U.S. Was super low. So you had basically a labor shortage. And whenever you have that, you're going to have upward pressure on wages, which is what we were getting. And then the pandemic hit, and all bets were off on that. That trend was gone. I do expect that trend to reemerge, only because the participation rate has taken a huge hit. I do expect this to begin to mean revert, and I think getting back to 8% over the next 3, 4, 5 quarters isn't unrealistic. I expect GDP to continue to grow over time, which means you can still have rising corporate profits, but corporate profits would rise at a lower rate so that its share of GDP would appear to drop even though corporate profits are rising, which is why I think that markets will rise, but they certainly won't rise at the rate of whatever nominal GDP growth is. I think they'll rise more in line with the growth rate in corporate earnings, which will be subdued because I think you'll have a significantly higher growth rate in wages over 2022. So we're going to move to the next screen, and I'm going to reproduce this one over here because there are some trends I want to match up with the participation rate. Everything makes sense up to about the year 2000, 2010, and then it sort of doesn't make any sense, except it starts to make sense again at the very far right of the chart. But take this with you. Remember that this is what was going on with corporate earnings as a percentage of GDP, and we will try to explain that with the trends we see in the participation rate. All right, some interesting things here. This is the chart we saw on the previous screen. Notice that we, at the very beginning here from, this is 1940 something, 45, all the way to about 1970, we were in a very tight range, 49 to 51.5%. If we look at the participation rate during that period of time, it was in a tight range as well. But then you had, the social changes in the late 60s that fell into the 70s, and women became a growing percentage of the labor force. So you had an increase in the participation rate from about 60% all the way to 67%, a significant increase in the participation rate. But look what happened to the percentage of earnings that accrued to employees. It decreased as a percentage of GDP over that period of time, which is in line with supply and demand. You have a greater supply of labor. It puts downward pressure on any price increase. So had we stayed at 59 or 60%, I think this line probably would have continued on at somewhere between 49 and 52% as a percentage of GDP, because there'd be nothing to keep wage pressure down. Now, over this period of time, this is not saying that wages have declined. Wages have increased, but not at the same rate as GDP has increased over time, such that it became less and less of a share of GDP. Or you could say that, that GDP, more of the gains in GDP accrued to technology, which showed up in corporate profits. Then we went sideways for this period of time, and you can sort of say, well, with other than variability, we sort of look like we're going sideways over that period of time. Here's a bit of an anomaly here. If we look at, there's the year 2000, we sort of went downwards on the labor force participation rate. That you would expect, well, if you take from the same period of time, that maybe this should have done this over this period of time, but it did this. That even as the labor force was shrinking, the participation rate was shrinking, you had the percentage of GDP going to wages also shrinking at the same time. It was not putting any pressure on wages to increase. Only in this last period of time you see this upward trend going on right in here, and we see this. This ends at 2020 and this is 2020. So I'm trying to line up the same movements. You see that it is really beginning to increase, and that's only because you can do this for a certain period of time before you create a labor shortage, you create a tight labor market, and you're going to get wage inflation. And before the pandemic, this is what we saw. We started to see increases in wage inflation in the labor data, which is always a positive, but you also started to see a slowdown in the growth in corporate profits. Well, that all fits. It's this arrow here, this drop here, along with this drop that doesn't fit. I would have expected this to increase. Now, you can argue, well, this is going to happen with a lag. Okay, but we have this trend going on, and we have a labor force participation rate which is 61.8. I don't think you're getting back to 67%. I think that this is probably where we're going to end up, somewhere around 63%. So I think the labor market is going to continue to be tight into 2022. And the supply issues we're having, the constrained supply, is not an issue of physical capacity or shortage of physical capacity. It is a shortage of labor capacity. So I think that's going to continue into 2022, more than just the second half of 2022. So I don't think that inflation is simply going to end or abate sometime in the first half or even the third quarter. I think maybe late into the year you might have slightly moderating inflation. If wage inflation begins to pick up a little bit more, once you start seeing wage inflation of 5.5%, 6%, that's the right path to head on. But you're not going to have that and have corporate profits come in at 12% of GDP or even 13% of GDP. So think about the multiple that we apply to markets. If you have, here's the 6% line. If you have corporate profits that mean revert around the 6%, you may have a certain multiple. But if you have corporate profits that become a larger percentage of GDP, you'll have an increasing multiple as well. Well, if you have them decreasing over time and mean reverting, you probably would end up having a lower multiple. So is a 22 or 23 times multiple on the market going to be what we're going to see in 1 year? You may have higher corporate profits at lower growth rate, but if you have multiple contraction down to 20 or 21, you could have a sideways market into next year. So the equity market, I think, is going to be under pressure next year. I'm not predicting if there is any upside to the market, certainly not double digits. But this is a problem that needs to be fixed. And it's going to be fixed with this. That was a terrible color to draw with this over here. Is you need to have wage inflation. With wage inflation, wages will become a higher and higher percentage of GDP. The share of corporate profits as a percentage of GDP will decrease over time. It'll still add price pressure because that's what wage inflation is going to do. It's going to add price pressure. But it all comes down to this. This is going to be another hot number that's being watched. What is the participation rate? You need to see that grow significantly. You need to see it get above 63% to really relieve this supply constraint pressure in the economy. That's a big move. Getting from 61 to 63 and then getting above 63 is a big move. So I'd say going into next year, we're going to be watching inflation. That is going to be a hot number to watch. In the jobs report, this is the big one that I'm going to be looking at, is that participation rate, because that's going to tell me everything about supply. Is what is the participation rate and what is wage inflation. That's another one to look at. Hourly wages. What is the price index on hourly wages? Okay, let's move on. So let's sum up what my position is going into 2022, or at least what my thesis is for the economic environment. And for those candidates at level 3, this is called forming capital market expectations. And I'm a retail trader, so I try to make this video for everyone else who's retail a trader as well. I'm not trying to use a lot of sophisticated data that you're simply never going to have access to unless you're part of an institution. I wanted to make it as accessible as possible. So when I call them capital market expectations, these are broad themes. I'm not sitting down and calculating what I think expected returns are for certain asset classes, but I will, on the next screen, give you what I think is an expected return on a broad market equity index, which is the SPY, and expected return on a ETF that tracks bonds, the TLT. So I do see wage growth into 2022. It's the only way you're going to solve that supply issue is wage growth, and we are seeing it ourselves. Our IT, we have an IT team in Toronto, and we just lost another one to a larger organization that significantly outbid us. So, we're not alone in that situation. I've talked to a number of people who have tech departments, and even spoke to somebody who leads up a large tech network, and it's a common theme. Everyone is having a hard time finding employees, and it's not just tech; it's a whole bunch of different areas, but tech most especially. Is somebody will get a job with you, 3 months later they're hopping to another job because they can get an extra 10 grand. Everybody's stealing from everybody else. So you're going to get wage pressure one way or another. I do see improving supply, only because if you have wage growth, it is going to, at the margin, bring people back into the labor force. So you will have improving supply. Corporate profits as a share of GDP, I do expect are going to drop, mostly because you're going to have this. So I do expect it's going to drop. Number of reasons, starting next year, January 1st, 2021, U.S. corporations are going to be facing higher tax rates. They have higher input costs, with wages being a significant input cost. If you take them as a whole, the S&P 500 components as a whole, they do not have 100% pass-through. So less than 100% pass-through. As a result, aggregate corporate profits as a percent of GDP, I can see as a percent of GDP will decrease. That does not mean that there's negative growth in corporate profits. Just you may have GDP growing at this rate and corporate profits growing at this rate because wages are growing at that rate. That's an acceptable outcome. If wage inflation is leading to lower growth in corporate profits, you could make it up in volume as long as you continue to improve supply. Higher yields, I don't think it takes much to get to that point. If you have higher yields, you're going to be negative duration anyways. I think we have lower equity growth rates, still positive, but lower equity growth rates. Moderating inflation, maybe coming down from 6.8% down to something under 5%, or maybe around the 5%. Not disappearing inflation, but moderating inflation, because you got to solve this wage issue. And you have to improve the participation rate, which we saw on the previous screen. And you have to get that well above 63% to begin to solve all these supply problems right now. Sometime in the second half, probably later second half, fourth quarter, moderating inflation. So let's look at setting up exposure to positive beta. Here I'm talking, in terms of factor exposure. We want market exposure and negative duration. And we can get positive beta by being long the SPY, which is an ETF. And you can get negative duration by being short TLT. So let's look at what it costs us and what our return is per 100 shares if we were just going to do this naively. Naively meaning let me buy 100 shares and short 100 shares. So we're going to buy 100 shares of SPY. When I did the video, I looked at the price. SPY is running at $468, so it'll cost us $46,800 US. We'll short TLT. TLT was around 151. We don't get to use this money, by the way. That's restricted, and we're going to need a margin if we're going to short TLT. So you need 46.8 to buy 100 shares of SPY. You need 4,500 in margin. You need $50,300 to get that done. For 2022, the consensus earnings on the S&P 500 is 222.32. Consensus means if you take all of the estimates, and these are bottom-up estimates, not top-down, but bottom-up. If you take all of the estimates provided by all of the investment banks, you take the average of that. That's what the consensus view is. Consensus is, I think, as precise as you can get. You're in no position to do a bottom-up analysis on 505 companies and do any better than these people who do this day in, day out. At some point, you have to rely on experts, and this is what we do. But rather than rely on one expert, we take all the experts and we take the average of all the experts. That's your consensus EPS. Even if we keep a multiple of 22.5, and we can say, okay, well, real GDP growth can make up for the drop in the percentage of corporate earnings in GDP and offset it such that we can stay at a constant multiple. You get to $5,000 or roughly $500 on the SPY, from $468 to $500. Not a lot of upside there. Okay, let's put some price targets on SPY and TLT. SPY, I'm gonna go to 510 instead of 500. I'm going to say, well, you know, we do have still some optimism, and I think as the market tends to improve, yields are still low for a period of time, so that will keep multiples elevated. I think 500 makes sense. Going to 510, I think, would be a good scenario. 8.97% upside. Now the SPY does have a yield of, I think, 1.3%. So you'd be just a little over 10%, but we're just going to work on price here. Per 100 shares, if we bought at 468 and our price target was 510, that's 4,200 return on that position. Short 100 shares on TLT with price target of 13.5, that is an expected return of negative 11.25. And it does have a dividend yield as well. Since we're long and short, the yields are very close to each other. I just don't count them because they'll cancel off. If you're short, whatever you receive from SPY, you would only have to use to pay out on TLT because you got to pay the short side. That is 1,700 to the downside because we're at call it 151, 152. So 5,900 if you had 100 shares long on SPY and short 100 shares on TLT. Remember, it's going to cost you $50,300 to get that done. So you're looking at an 11.73% return over the next 12, well, I'll call it 13 months because these are, I'm going to mimic this with January 2023 options. So 11.73% return. If we use the SPYs, the options, on SPY, if I have a target of 510, what I'm going to do is I'm going to sell very deep in the money options here. I'm going to sell a 510 put. You're getting $62 for that today. I've already sold some of these today for January 2023, the 510 put at 62. Now there's a big spread. It's like 59.31 to 63.86. However, if you calculate halfway through the spread and put a bid in, I got dinged right away. Right away, no hesitation. As soon as I hit put the order in, it was filled immediately. So even though there's a wide spread, there's still a lot of liquidity in there. Just find the halfway mark and put your bid in, and you'll go. Typically, I find the halfway mark, and then I'll go up like 10, 20 cents just to say, you know what? Let's see what happens here. I got filled without issue on that one. So $62 on this. Let me erase this. That was a note I had left for myself on something else. So I get 6,200. If you buy SPY and it gets to 510, you make 42. Look, I get 62. So I'm basically making an extra $2,000. In essence, buying it for $20 cheaper than you're buying it. So if you're paying 468, To get it, I'm paying $448. That's what that little note there was. I'm paying roughly $448 to get it, and I get the same income that you get. The only time that you would do better than me is if this goes above 510 by at least $20. It's got to get above 530 for you to do better than me selling the put. For TLT, I'm going to sell the call, the 135 call, and I get $18.60 per call, or $1,860. So there's $8,060 that I receive. By the way, if you did this, you got to put out $50,300 US. I don't have to put out anything here. I receive $8,060, but I do have margin. On the SPY position, it's 14,250. On the TLT, it's 45.50. So I need another 18.8. And I kept all the dollars the same, even though I'm in Canada. I kept all the amounts in US. 18.8 is what you're going to need for margin. So 8,060 over 18.8 is 42.87% using options versus 11.73% being short. For being short, for buying it natively and holding the actual ETFs themselves. I don't have that situation over here. I'm putting out. You have to put out 50,300. I have to put up 18.8. I can put this in cash securities. I can put these in T-bills, 90-day T-bills, and roll them over, so I can get a cash rate on this. You can't, because you've parted with this. I'm also receiving 8,060. This is the margin I need up and above what I receive. What I receive is restricted as well, but I can take this 8,060 and also put it in cash T-bills as well, so I'll be getting a cash rate on top of all that. And if we do expect rates to increase over the year, the cash rate is going to increase. At the short end, if rates go up 25 basis points, 50 basis points over the year, the cash rate will increase as well. This is a much nicer way to get it done than buying the ETF natively. I'm putting out significantly less money. If you think about the margin as putting out money or putting money into something that you can't touch. Significantly less, and my return as a percent of capital, if I call this capital invested, is almost 4 times higher. This works well right now because volatility is still elevated, so there's a lot of money in the premiums. So it makes sense that whatever we're going to do now, we would want to lean more towards the option market only because of the sheer volatility in there. Even if none of these things go anywhere, let's say we end the year at 468, the market went sideways, and let's say this didn't budge from the 151 it's at right now, you would make nothing. If you had bought the ETF and shorted the ETF, you'd have nothing. But I would have 42. The puts would be worth 42. I got 62, so I still have 2,000 that I made on this one. And this has got 16 of intrinsic value. That's 1860. I make another 260. I still make 2260 on the 18.8, which is still, I'd say it's pretty close to that 11.73%. It's over 10%. 10, maybe 11.5%. I'd still make what you would make, even if nothing happened and you made zero. I'd still make when I say you, I mean the generalized you being the one that bought the ETFs directly. So there's a lot of power in the options because there's a lot of time value in these options as well. So, somebody can say, well, what's the risk here? Well, the risk is you could be wrong, is that SPY could continue to drop and TLT could continue to rise. However, this is still less risky than this, only because, again, my break-even is $20 lower than yours, and my break-even here is $2.60 higher than you. So I still have better break-evens than you. I'm making a higher ROI than you are as well. And these options, TLT is very liquid for January 2023. The spreads are not that wide, and if you put a bid in the middle, you're getting it. And even though the spreads are wide on the January 2023 SPYs, there are people in that spread As soon as I hit, place the order, it dings right away. There's no waiting 5, 10, 15 minutes. There's somebody there on the other side right away. Okay, two more things I want to point out. One is more of a macro trade. The Canadian dollar. I am puzzled by its weakness, but it is at 128.19 today. This is the US CAD pair. This is in the market. You read it as the first of the pair is the one US dollar buys 128.19 Canadian. At this time last year, the Canadian was about 131, 132, and I had said that I expect Canadian dollar strength over the year and for the dollar to end somewhere around 118. But that happened sometime in July. We got to about 120. It happened really fast, and I figured I had a target of 118. So at 120, I removed all hedges I had on the US dollar, figuring that any upside to the Canadian was limited. And it turned out that I got lucky on that one because we're at 128.19. But now I'm re-hedging everything out again. So there, and also placing a directional bet on the Canadian versus the US dollar. I don't know that. Two of the things I can't explain: U.S. dollar strength, really, and Canadian dollar weakness, given elevated commodity prices, and given that the Canadian Central Bank is not relaxing its inflation target of 2% like the U.S. Central Bank did, and that its first interest rate hike is expected in April, well before the U.S. begins to raise rates. And we have excellent job numbers, good GDP numbers, and running a trade surplus. So all indicators would suggest that the Canadian dollar should be significantly stronger than where it is, sitting at 128.19. But I think it's going to be under pressure until Wednesday, until the central bank, the Fed, says what it has to say. And I think a lot of the news that is expected is front-end loaded into the US dollar right now. But I'm taking a longer term view over the next 12 months, not just what I want to trade this week. And I am bullish on the Canadian versus the US. Now, there are two ways to trade a currency. One is a spot transaction and the other is with futures. I'm primarily going to use futures because if you're trading spot, you have a bit of a problem. When you trade spot, you're going to get, and you trade this pair, if you're going long the Canadian, which means you're selling this pair. If you're selling this pair, you're selling the first of the pair, you're selling the US dollar, which means you're long the Canadian. You will, in your account, get two currency balances. You'll get a positive Canadian balance and a negative US balance at this exchange rate. So if you multiply your negative US balance by this exchange rate, it should equal your positive Canadian balance so that the net difference is zero on day one. The problem is your negative US position is going to have an interest rate cost. And it's going to have your broker interest rate cost, not a cash, not an interbank interest rate cost. So you're not going to get, 0.03% on an overnight on the overnight rate. You're going to get 1.7, 1.8, maybe 2% interest cost on this negative US dollar. So I would only spot out as much as I have a positive US dollar balance. So I have sold, as I've said on the previous screen, I've sold 510 puts. I've sold 135 calls. I've done a number of these as well, which are short strangles on GM. I'm loading up on a whole bunch of volatility right now, or I shouldn't say loading up. I'm shorting a whole bunch of volatility while still getting the long and short positions I want by using heavily in the money options, but they have huge premiums in them. So I'm building up a US dollar balance, of which I do not want, so I will spot out until I have a zero US dollar balance, because this gives me a negative balance, so I will do that until I get to zero. After that, I will be long Canadian futures. And right now, and I'm using the December 2022 contracts, they're 100,000 each. The underlying of each futures contract is 100,000. 0.7785. Two reasons why I like to use the futures is I don't get a negative balance. I have more margin, 7,500 margin versus 2,500 margin if you use if I do 100,000. I think it's 3250 would be the margin on a spot transaction for 100,000 versus 7,500, but this could be in anything. It doesn't have to sit in cash. But what I like about the futures is I'm not going to get any change in my account balance except for the mark-to-markets, but anything that's mark-to-market will be mark-to-market in CAD. There's no US involved in this. All my gains and losses will be in Canadian. Not only that, this has options. So if I ever need to change my risk profile, I have liquid options. Spot transactions don't have options. You're just in and out, in and out, in and out. That's it. That's all you can do. So there's not much you can do to manage risk. So the CAD futures are better, and I'll do some videos later in the year on this position as it changes. And if I do have to use some options to change my risk profile, I find that a good opportunity to put a video out. So the bid and ask are pretty wide. The 7785, this would be to 7800. But if you put your price in, you're going to get hit. I didn't have a problem getting hit. It does take some time, sometimes 15-20 minutes, but between the movement of the currency, you get picked up with and if you take 1 divided by 1.2819, it is higher than this. So I'm actually going long at a lower rate than what the spot is right now by using the futures. So I will build a position in this. I am building a position now. There's, you got to start ahead of the event that you want. Wednesday's the event, the central bank event. I expect the US dollar is not going to give up any of its ground until the announcement is made, and then there'll be some adjustment after that. So you never take your full position whenever you have an idea. You build your position over time. Those who get greedy and want their whole position right away, well, then you need your position to work out in the direction you want right away. Experience will tell you that the bigger the position you take, the more you need it to work, the more likely it's not going to work. The market will look at you and say, somebody here needs a lesson, and you will be taught a lesson. Billions of dollars will come to bear upon your position just to teach you a lesson, or at least it'll feel like that's going on. This is an interesting one, GM short strangle. Last year, GM was sitting around, when I started picking it up, around low 40s, around 42. And what I did, this was November of 20, is I went out to January, this was November, I think, we're in 21 now, yeah, so this was 20. So I went out to January 22. That's right, because these expire next month. And I sold $60 puts. And I did $55 and $60 synthetics. Well, these are all the options are in the money. I don't want to close them out because it's only December. I close them out, I got gains on the books for this year, so I really only want to close them out once we get into January. So hopefully GM will stay in a nice enough tight range. But I started building the short strangle for January 2023, and I'm using an 80-90. This means that I am selling a put and I'm selling a call. That's a short strangle. The combined premium is $25.90. So here's your payoff diagram for this. I did it as a Friday close. GM was at 63.20. It got hit. Today it's down around 59, but I'll tell you, I was never more happy because I needed to stay under $60 by options expiration this Friday. I'll still make money, but I make the maximum amount if it stays under 60 bucks by this Friday. And I'm kind of greedy when it comes to winning this way, is I want to win it all. So I'm hoping it stays under 60 bucks to Friday. So I'm more than happy with the drop. But I started building a position in the short strangles. Here's the payoff chart. If you do one short strangle, since it's $25.90, $2,590, you'll notice that between $80 and $90, that's the maximum you'll make. Your break even, you have two break even points because you sold the put. 54.10 is the break even. Now I did this when GM was at 61. My break even's 54.10, almost $7 a premium in there. And if it goes above 90, it would have to get above 115.90 before. This is the realm of losses here. After these points, that's where losses would incur. GM's gone from 42 to, well, we're just sitting under 60 now, 59 and change. Almost a 50% increase over 12 months. Are we going to get another 50% increase over the next year? That would bring it to 90. I don't think so. I don't think we'll get another 50% increase. So, I think we'll be somewhere 80 to 90 in here if the chip shortage starts to repair itself mid-year and demand stays robust. There's good wage inflation and they can sell all that they make. I think they'll do very good if they don't have to start discounting. I like GM because it has very liquid options on both sides with nice high premiums. So sometimes, you can try to find a stock that'll do this and get in on that, or you could try to find a stock that'll do this, but when you use the options, you can engineer a much higher rate. Well, these are hard to find. Oftentimes you're getting lucky. Nobody really knows if a stock is going to grow at 300% over the next year. You were in it and it did that and you got lucky, or you got in early and you believe the hype and you got in early. I can get the same types of returns, sometimes even better, if you give me a stock that has some volatility, but is not doing this, but has some volatility. When it's doing this, and if I'm selling calls, I'm constantly being called away. All I can do is sell puts. But with this kind of price trajectory, I'm not comfortable selling puts at all. Because I always think, listen, it's overvalued as it is. I don't like it. I like something that is undervalued, that has some volatility. I can work with calls and I can work with puts. So that's what I'm doing with the GM with the short strangle. I did very well over the last 12 months with GM, very well. I'm expecting the same over the next year. That when you have something this nice that has these premiums in the options. You can make a business just out of trading in and out of the options on one stock. And that'll end it here. Before you go away, a word. I'm going to continue to do the applied series into next year. I'm going to try to do one a week or one every 2 weeks. However, they will end on YouTube. I'm not going to keep posting them on YouTube. I'll post a couple more on YouTube, and then they will only be available on our site for our current subscribers. As just an added benefit of being a subscriber is you'll have access to the applied series. But I will continue on YouTube to put out an applied series that deals more directly with more political or social issues. What in the content of the 3 levels can we learn that we can then apply to solve some bigger social problems or some bigger political problems? And in doing so, we gain a better understanding of what could work and what most likely will not work, hopefully. And most of that will be based on a centrist position. In other words, I'm not going to lean left or lean right. I'm going to stand right in the center because I think that the best conversations are had in the center. Once you start walking towards the wings, you start to become intolerant to the other side. And each side has good points and each side has bad points. Each side has its smart people and each side has its crazy lunatics. So being in the center, I find, is the safest place to be. Anyways, there we are. If you bought a hat, please upload a picture. It doesn't cost you anything to upload a picture. It costs me $25 because I get to add $25 onto our donation. Anyways, that's it.